Hi, it's Paul Sankey. July the 4th week coming up. We'll be back in Brooklyn by the end of the week. July the 4th, not a celebration in London, as you can imagine. What has been notable has been how busy it's been as we've traveled across Europe. We came back from Paris on Thursday. London is buzzing, big concerts in Hyde Park. You've had the Glastonbury Festival this past weekend where 250,000 people in a field in Somerset for the first time since COVID. So there's clearly a major resurgence in summer travel. My concern is that that will give way to a long winter of high prices for energy and economic slowdown. But for now, everything's buzzing in Europe and Morocco for that matter. That hasn't helped the oils. The impact note of the past week was our commentary on how we saw the oil group relative to the market peak on the same day basically as the inflation print, certainly relative to the market. And the oils have been down 20% since then, 15% relative to the market, which was the peak print. If it was the peak print, it was June the 10th, sorry. And ever since we've been struggling. But the theme continues because we've seen the G7, for example, this weekend talk about countering China's Belt and Road Initiative with a $600 billion investment program, really in renewables as much as anything. I mean, it's a slightly odd list of stuff that's been highlighted. There's a solar project in Angola, a vaccine factory in Senegal, which for me don't add up to $600 billion, but then a telecommunications cable from Singapore to France via the Horn of Africa, which sounds like it could cost $600 billion, quite frankly. But the big theme is that you're going to continue to see the pursuit of renewables and higher energy prices, and the peak cheap energy is behind us. And that essentially means that we're going to be transitioning from the inflation phase of our call, which was really from post-COVID. We started saying if the Fed wants inflation, it will get oil inflation, and that will be bullish for the oils. That's now going to turn into buy the bottlenecks. So our current theme, along with peak cheap energy, is buy the bottlenecks. And obviously that would be refining. It would be LNG export facilities in the US. But equally, you could argue that there's a bottleneck in global oil and gas supply. For example, yesterday I was writing about how Algerian gas supply, which everyone seems to assume is internally large, is actually alongside Algerian domestic demand. Algerian gas supply to Europe is forecast by Woodmac to peak around 2025. And yet, as I mentioned, the G7 shows no appetite for reinvestment in major gas supply or oil supply for that matter. So the theme is going to move as part of buy the bottlenecks and the end of cheap energy into a tough market, because it's going to be towards recession and certainly towards energy consumption constraint, which tends to indicate recession. And, we continue to believe that the energy stocks will represent very good value. And yesterday, again, we were highlighting Hess and Exxon. Exxon's a double winner in many ways because it's got both refining and Guyana, but obviously Hess and Guyana is a wonderful long-term asset in terms of the shortage of global energy. As we end the quarter, I'm just looking down at my notes here. I haven't done a very good job of looking at my notes, have I? But as we end the quarter, I just highlight as well, which is somewhat negative, but I think we've more than discounted this, that WTI is actually averaging less than street forecasts for Q2. So it looks like we'll come in at about 109 WTI against street forecasts of 111. Brent looks in line. Looks like we'll do about 114 for the quarter. Street forecast for 113. And natural gas is down at around 610 right now, but that's actually in line with street forecasts. In fact, no, I'll take it back. We'll do about $7 for the quarter, with the street at more like 6. Natural gas is one area where it's clear that street forecasts remain below the strip, and that's an area we like. Tourmaline, Chesapeake, the refiners on the bottleneck call. These are the things that we like. Why am I wandering around like this? Well, I was going to show you London. So, but basically speaking, it looks like refining earnings estimates have to go up more yet, and we love the refiners. It looks like natural gas is undervalued by the street. We love Natty. Keep in mind that many of the E&Ps are stealth natural gas companies. So, you know, you'll still see, for example, EOG, you can buy it as a gas export play on the Dorado resource. I'm trying to see if a bus will come past, it won't. So that's Hyde Park. The Rolling Stones were playing over there. We talked about it yesterday. Decent crowd, but not the 250,000 that they did in 1969. With Mick Jagger at 78, it was quite interesting. In fact, last night you could hear the Eagles playing, and you'll never guess what song I heard.